Hello and thank you for this opportunity. Today we'll be looking at the potential of getting more bang for buck from a sea change through capital growth on Sydney's northern beaches. Smart Capital is an investment firm that seeks to identify growing residential property markets in Australia and New Zealand. Ideally, they like to invest $100 million upfront with the intention of holding the assets for 5 years before selling them at a 50% return. The CFO has asked two analysts to re-evaluate a decision to invest in Sydney's northern beaches. The analysts hypothesise the investment will still be a good one, mostly based on the amenity of the area and the proximity to the city. However, they're also interested in some other factors, including improvements to public transport, a proposal for a new tunnel, the number of new dwellings scheduled to hit the market, access to credit tightening, population growth within the region, government intervention, and a newly developed hospital.
Between 2012 and 2017, the Northern Beaches Council Area, or short for NBCA, experienced great supply growth for houses and units. NBCA's auction listings and clearance rates also experienced an increase, indicating increased demand for properties within this area. This coincides with the increase in the Westpac Consumer Confidence Index. The supply and demand growth for NBCA resulted in its median property price increase surpassing that of inner Sydney.
The key supply factors driving property price in the NBCA between July 2012 and June 2017 were cost of financial capital, business lending rate decline due to a strong competition in this lending market, dwelling stock, availability of business credit, and price of input. Building construction costs were rising at a 4.9% annual rate in New South Wales in some recent years. The key demand factors were availability of consumer credit, population growth of NBCA, renting as a substitute to buying in NBCA, income buyers, housing loan interest rate. The average standard variable housing loan interest rate decreased from 7.3% in 2013 to 5.8% in 2017, and positive information. New South Wales economic growth was projected to improve from 2012 to 2017, and interest rate remained low. Demand was strong due to a solid population growth as a consequence of overseas migration.
There have been a number of disrupting factors that are expected to impact residential property prices in the Northern Beaches from 2017 to 2022. On the supply side, the local government's development of the area will result in an additional 4,500 dwellings, significantly more than the 5 years to 2017. Interest rates are forecast to increase slightly, which could reduce investment in the long term. However, we do not expect any major impact in the short term due to the New South Wales government's aim to improve housing supply. In early 2018, many large financial institutions and leading economists forecast negative property price growth, which should cause some investors to hold off selling due to lower expectations of future value. On the demand side, the Northern Beaches population is forecast to increase by around 8,000 people, lower than the 12,000 people in the 5 years to 2017. The government has implemented schemes to help first home buyers enter the market. Planned improvements to infrastructure and transport will increase the desirability of the area. Access to credit is tightening due to regulator restrictions. Interest rates are forecast to increase, which will reduce purchasing power. The Chinese government has restricted capital outflows, which will impact the biggest foreign buyers. The Australian government has also increased taxes on foreign buyers. And finally, the New South Wales government's housing affordability package means that neighbouring suburbs will potentially offer cheaper housing alternatives.
The next part of our presentation will answer how and why did the property price change between 2012 and 2017? How will this be different in the next 5 years, and can we achieve our investment objectives in the NBCA?
The key supply factors between July 2012 and June 2017 were strong competition in lending market, decreased business lending interest rate from an average of 6% to 4.5%, shifted the curve to the right, and increased elasticity. The total number of dwellings in NBCA increased, shifted the curve to the right, and increased elasticity as well. Business loan approval experienced growth from 2012 to 2017, shifted the curve to the right, reduced barriers to entry, increased price elasticity of supply. Price of input data does not indicate any effect. The overall effect in the supply for housing in the NBCA was a shift to the right and more elastic supply.
The tightening of consumer credit by APRA's regulation shifted the demand curve to the left. As mortgage repayments represented a large proportion of total budget, price became more elastic. The increase in population growth shifted the curve to the right. As this increased the perception of housing as a necessity, it became more inelastic. High rental price attracted investors and buyers. This shifted the curve to the right. As availability of close substitutes reduced, the curve became more inelastic. The increase of income of buyers also shifted the curve to the right. There is minimal effect on elasticity. Decrease in home loan interest rates increased housing affordability, shifting the curve to the right. The proportion of total budget decreased, causing the price to become more inelastic. Positive information about the property market also shifted the curve to the right. Having housing as top-of-mind investment caused price to become more inelastic. In 2012, the supply and demand curves intersected at point A, representing NBCA's median property price of $780,000. When factoring in key supply-demand factors, the curves have shifted, moving the equilibrium point upwards and to the right. Now, B is the median property price in 2017 of $1.2 million.
The analysts determined there were two key factors driving supply in the future. The number of sellers was going to significantly increase supply, primarily due to the state government's plans to address housing affordability. In addition, there are over 4,000 new dwellings scheduled to hit the market. The second factor driving supply in the future is changes in expectations of future value. The forecast of negative house price growth will lower expectations and investors may hold off from selling. Overall, supply is expected to shift to the right, and because of the government's plan for how many properties they want and the fact that they are making it easier to develop, this will also make the supply curve more inelastic in the future.
Population growth and desirability of the area is expected to shift the demand curve to the right. It is also expected to become more inelastic due to new residents regarding housing as a necessity. Subsidies for first-home buyers is expected to shift the curve to the right, but only by a small amount due to the relatively small percentage of extra buying power. The curve is expected to become more inelastic due to the reduced amount of total budget required. Pressure on lending standards by regulators is expected to reduce access to credit for many and shift the curve left. Many buyers are already close to repayment capacity, so demand is expected to become more elastic. Interest rates are forecast to increase, which will further reduce borrowing capacity, shifting the curve left. Higher rates reduce the total budget, leading to more elastic demand. Foreign buyers will be hit with taxes and Chinese buyers with local capital controls, which will shift demand to the left. This will reduce the total budget, making demand more elastic. The housing affordability focus and dropping rental prices will shift demand left due to cheaper alternatives, and demand will become more elastic.
Combining the expected changes in supply and demand in the future, the analysts are able to forecast a decrease in the equilibrium median dwelling price from point A to point B.
While dwelling prices have increased by 70% between 2012 and 2017, the analysts concluded that this growth cannot be sustained. The prices are expected to decrease due to forecasted reduce in demand and increase in supply within the NBCA. The analysts recommend that Smart Capital Inc. liquidates its property investment in the NBCA with immediate effect. This is to avoid forecasted capital loss between now and 2022.